Jeff deGraaf, let's go back to what's happening in yields, because I know you're watching those closely. Where's the next stop?
Well, the 10-year, I think the yields trade down to about 388 or so, and then from there it's about 370. I'd feel comfortable with yields doing what they should do, anywhere between here and 360. Under that, and that starts to get a little uncomfortable from what the market's message is about the economy. But I actually think this is really good news because it implies that the inflation that people are concerned about probably isn't a problem, at least from the market's perspective. And keep in mind, we've got this dearth of information because of the government shutdown. So, we're kind of trading in a vacuum here as far as the macro data is concerned, at least.
You say that the move lower supports the quote-unquote, we ain't seen nothing yet, potential for this market. Is that because, okay, it just supports the whole notion yields are coming down, Fed's cutting rates, economy's hanging in, and then it's off to the races like some are projecting this market could go?
I think that is spot on. I think the risk to the market is that the economy, the real economy, is weaker. It gives the Fed all the cover they need to cut rates, and as you said, we ain't seen nothing yet if that's the case.
Yeah, Mike, it's interesting. I know you listen and read Jeff's stuff. What do you think about that? It's only going to get people more excited if they are convinced that rates are coming down while the economy is still okay.
That's right. No, and it's while the economy is still okay. So the whole premise of why we got here, right? Why we got to 6750 or whatever on the S&P was because Fed was going to be cutting. It was going to be the second annual soft landing execution successfully, and it wasn't. And that we also have this sustainable disconnect between job growth and GDP. And we also have the ingredients for a reacceleration next year. I agree with all that. That's why we're where we are. Regional banks can't go down every day like this and have that story be intact. I'm not panicking out of it, but you have to pay attention to whether, in fact, the market is starting to get nervous that you're seeing some stress points in either the real economy or, the funding markets or something like that. We've had more false alarms than real alarms over the past few years in that, but I do think you have to at least pay attention to it. And that is, in the absence of official data, what you have to struggle with, exactly what the trajectory of the real economy is.
What about that, Jeff? The idea of these regional banks, top of the headlines, the alts managers, top of the headlines, the stocks of all of those together are not trading well.
No doubt about it. I mean, I don't worry about the regionals so much. I think there's a little bit of a disconnect there. The alts are far more advanced in terms of a topping pattern. As Mike said, is this a false alarm? Is this issue specific to First Brands and the like? We'll see. I mean, clearly the growth in credit was from the private side over the last 10, 15 years. So, if you're going to look for a spot where there might be trouble and, maybe a little lowering or lax standards, I think that's exactly where you'd want to look. So, look, I'm personally, we're short these things as the hedge against the bullish call. But keep in mind, perversely, if it is bad enough and it gives the Fed more fodder, that's, again, still good for these stocks, particularly these concentrated stocks, as this kind of blue sky narrative continues to play out and probably build.
Yeah, don't fight the Fed has broad meaning to many, doesn't it? What about the gold? Are you watching gold, and what are the charts telling you? Now I'm hearing 5,000. Before it was 4,000, now it's 5.
Yeah, look, I think gold is certainly in an uptrend, and we're hearing a lot of talk about bubbles in the equity markets. I don't think if it is, we've only just begun. Some of the things that we look at for gold, this kind of excess alpha that we look at, we are now rivaling where we were back in 1990. So, with that doesn't mean sell it. What that means is that, hey, we're likely entering a bubble phase, and so I need to be very, very careful about how I play that. Which is, I don't want to be in a FOMO position, right? In other words, I don't want to be playing from a position of weakness, in these types of environments. So you hold on tight, you look for it, you peel some of this off systematically. Everybody talks about dollar cost averaging. We talk about dollar cost selling when we get in these environments, but that's just begun for gold. And I think that's important.